Hello, everybody. Thank you very much for joining this webinar. Today, we're going to talk about the finance can find new ways into China. Today, I'm your moderator, Robert Burst, Director of Sovereign China. And today, I also promise to keep this webinar under or around 50 minutes. We suggest you to connect to the internet by cable or sit close to the Wi-Fi for the best experience. Today there will be 3 speakers. Each will make their own case about their subject, and afterwards I will ask some questions to them. If there are any questions from the audience, they will of course be able to ask then. But also at the end of the webinar, you will have the opportunity to ask those questions. The webinar will be recorded and it will be made available at the end of the webinar or afterwards. The slides will not be directly shared because we don't have so many slides. Behind the scenes, we have a moderator that can help you if you have any technical issues. So today we have, as I said, 3 speakers. Mark Shaw from Kingwood Madison, Wagin from China International Capital Corporation, Michael, and they will be talking about the subject. And I think it is also important to know that China has been opening up. On September 2nd, Citibank was licensed by the Security Regulator Commission to provide custodian services in China. That made Citibank the first bank among the top 5 to get this license. And China has clearly been accelerating this industry and opening up for foreign companies, which was previously a closed market. And today we're going to talk about how China is opening up and its implications. First speaker will be Mark. Mark is the international partner of Kingwood Madison and has been working as a lawyer in Shanghai since 1983. He normally travels between London and Shanghai, but of course now he's confined to his house in London. He's also the writer of the book The Art of Law, and especially for him, we have put it there just to make him a little bit more happy. Mark, hereby I give you the floor to talk about the implication for foreign family offices, asset management, and non-performing loans. So please, the floor is yours, Mark.
Yes. Thanks, Robert. So you'll move the slides? Yep.
Yes.
You'll move. Yep. Thanks. So I mean, just one small correction. I'm not older than I am. So I came to China in '93, not '83. Anyway, thanks.
Sorry, I said 83. I'm sorry for that.
So look, I think what we've seen is just very briefly, what we've seen is in China over the last 20, 30 years. There's been a loosening up of foreign investment, except in certain key sectors. And I think until recently, we would have put financial services, futures, securities, fund management, asset management, all in that kind of bundle. But this negative list has been shrinking. Some things are still off limits, but I think it's interesting to see that the regulatory framework is allowing much more openness to foreign investment in what was hitherto things that were really held off from foreign investment. Next slide, please. And so I think one of the issues that we're seeing as well is that this decoupling, I guess we're going to have to change the photo soon if Trump ever concedes, but we don't, I mean, within the firm, we don't expect, maybe the personalities change, but probably this decoupling from China and the US will continue a bit. But in the financial sector, it's kind of interesting what we're seeing, and we're seeing just the green shoots of this. So we have a lot of Chinese clients because we're a Chinese law firm, and we met very senior people at the very large securities houses, and etc. And all of these people have told us that they want to internationalize their business. And for these guys, it's not really going overseas. So it's not like the Chinese handset manufacturers or even Chinese auto manufacturers. I think the Chinese financial services companies, they actually want to bring in Western expertise. They want to partner with people in a variety of different companies in different sectors. And so I think, even if we see that the US is trying to stop China going into America, we see a lot of American companies, a lot of European companies starting conversations with us about issues like, non-performing loans, hedge funds, and at the moment they really haven't yet really started, or at least they haven't started with us. But I think something's going to happen because the Chinese side wants to have this engagement. They want to open up the market, and I think for an American company in this space or a European company in this space, it's just too big. You can't ignore China, but you may not be able to do it fully by yourself. So I expect to see a lot of joint ventures, and we saw it with UBS increasing, their shares in the asset management company, and I think it'll be a bit like hopefully it'll be a bit different from the banks. So, in the past, foreign companies did have shares in Chinese banks, but rapidly the Chinese banks didn't really feel that the foreign banks had that much to offer. I think with asset management, non-performing loans, hedge funds, it'll be a bit different. Next slide, please. So I think this is, what we're seeing already is, Trump did have some success with opening up stuff. Like you mentioned, Citibank is, opening up domestic fund custody. And I think what we see from a number of our clients as well, they have also said that China is their big white patch on the map. And so especially Europeans, even more than the Americans, are trying to get a foothold in China. I'll go to the next slide to speed it up. So what we also see with market trends is, I think we're seeing some of the biggest companies who are listed overseas trying to go to the mainland or the new Star Exchange. But to be fair, there's been more IPOs in America this year by Chinese companies than ever before. So that's a bit, counterintuitive. Yeah, we see Hong Kong is still a very important place for the Chinese companies who are going out, but also foreign companies coming in. And so I think a lot of these financial services companies will still continue to use Hong Kong or Singapore as a bit of a staging post. But I think a real difference in the last 12 months is a lot of these companies really believe Hong Kong is not the same as being onshore in mainland China. So a lot of companies are talking about, if we want to do asset management, we can't just do it from Hong Kong or Singapore or Switzerland or London or Jersey. We really have to actually get onshore. London is an interesting sector because firstly, they're very interested to have these listings, but also London with Brexit, nobody knows what will happen. But London may well diverge from Europe. It may well be a place where Chinese people feel it's a good offshore location to store money. And I think those London financial services companies will be really looking in more detail. At the moment, there's a lot of sniffing around. COVID didn't help because people can't get on a plane, they can't talk to their Hong Kong colleagues, and to make these decisions, you need to actually go to China, I think, and have conversations. Next slide, please. And so the opportunities, where we're seeing people, and I'm, sitting in London, China-focused family offices, we get quite a lot of inquiries from people who are interested in providing family office services. Again, a lot of them already have a small offering in Hong Kong, but they feel that they may need to have some plan to go into China. I think one of the issues is people have discovered that many Chinese nationals or residents have large amounts of money which are already offshore. So I think, one of the big issues is, will we be able to see Chinese people invest easily renminbi going out of the country? That's really unlikely, I think, in the short future. But I think many people have recognized that China has so much wealth, a lot of it is already legitimately offshore. I think there'll be a lot of tech opportunities in the financial services space. And then I think what we're seeing is the capital markets. And then I think, basically we will see a lot of foreign investments coming in, and the Chinese authorities, and we've seen it a bit already with Chinese authorities revising their guidelines, the stock market, adjusting things, the Chinese stock markets having arrangements with Frankfurt, with London stock markets, where they're doing listings of GDRs and things like that. So there is a movement towards transparency and also standardization, but I think the feeling is it will be more Chinese than how a bank is run, because I think the Chinese way of investing, it may not follow the American or the European route. They may find something very different. So that was just a very brief view of what we're seeing. But at the moment, it's mostly grassroots rather than people actually signing contracts.
Okay. Yeah. So thank you very much for that presentation or your ideas of that. You already touched upon it a little bit during your speech, and of course the pictures showed it. There has been an election in the US, and maybe we have a new president, or the old one is a little bit unclear, but let's say hypothetically that Biden will become president. You don't see a lot of, you said you don't see a lot of changes. Why is that? And if there are any changes, where do you see these changes happen then? And what influence will this have, for example, for the financial sector in China?
Well, I think the thing is, I think firstly, I'm not a political analyst, I'm not an American, so I shouldn't really get involved in their politics, but you could imagine that the underlying theme of the trade war, it wasn't really a trade war, it was more perhaps a interest war, and so that's why it spilled into being a bit of a tech war and then a bit of a capital war. I imagine that perhaps President Biden would be a little bit more reticent, perhaps follow the model of previous administrations, which are not perhaps so aggressive. But I think the underlying issue is still there, that the US would consider China to be a bit of a competitor. But I think the other dynamic is that governments in Western countries don't have the same ability to influence their companies. So I think even in America, you can't force companies like Citibank or JP Morgan to ignore the China market. And China has developed so quickly, such a large pool of wealth, those companies can't really ignore it. And then secondly, because China, even though the restrictions are being dialed back, there are unseen restrictions, a bit of a lack of a level playing field, but also coverage. It's such a large country. And the wealth is not just centered like in the UK, like London has almost all the rich people. It's very much all over the country. So I think a lot of those companies, the ones we're talking to, except for the hedge funds, they're talking about joint ventures, they're talking about cooperative relationships. So I think that's the reason why I don't really think who the president of America will make a big
change. And the companies that are talking to you and talking about those joint ventures, what are their biggest concerns when entering the market?
Well, I think the biggest concerns it's a bit surprising, because if you've been working with China for a long time, you often think people would have moved on. But because this sector hasn't had a lot of exposure to China, people often don't really know how China's operating, even quite sophisticated people. So really, when we had a recent case with a company that wanted to do a joint venture for non-performing loans, and really 90% of their questions were corporate governance questions, like liability of directors, things like that. What comes up a lot is whether contracts are enforceable in China. So they don't really have technical financial issue questions. They're more concerned about bread and butter.
A lot of the basic questions they have.
Yeah, like a car manufacturer would have similar questions to these guys. It's not sector specific.
You've mentioned the non-performing loans, and we also, I think we've talked about it in the past. Why do you think that is such an interesting area in China? Why does it have so much attention? for example, from your clients?
Well, yeah, I did discuss this with one of the people who was talking about non-performing loans, because I said to him, why are these people all coming now and talking about non-performing loans?
Yeah.
The last 20 years, nobody talked to me about it. And like in the last 4 weeks, we had 3 different people asking about it. And he said, well, the reason is they got more non-performing loans than anybody else. So you go where the market is, and this will be the biggest market in the world by far. So if you're not there, you won't be able to participate. So for them, it's just a economic calculation that's where the market is.
Yeah. One other topic you also mentioned was Hong Kong. Of course, we've seen, and of course, I don't want to put you into a political discussion, but of course, Hong Kong has been a key area where finance starts. But of course, there has been a lot of changes over the last weeks, months, and where do you see Hong Kong in the future? Will it be overtaken by other regions, or will it still be relevant?
Well, I think it would be hard to imagine Hong Kong wouldn't be relevant. I guess it's just a personal view, not a view of the law firm or anything. But I think, it's not perhaps that Hong Kong will go down so much. It just, I think, China's opening up, and you look at the Star Exchange, I think it's already now, after 2 years, the most valuable stock exchange in Asia.
Yeah.
So, it's, Hong Kong will have a role to play, no doubt. But I think, the big picture is mainland China, because that's where 1.4 billion people are. And as it becomes more transparent and more open to things, that's where the money will be, and that's where people will do the investments. So I don't think Hong Kong is, going in a wrong direction. It's just the nature of China opening up that perhaps it doesn't have the same special position that it would have had 20 years ago.
Yeah. All right. Thank you very much for your insights into the subject. Then I would like to move to our second speaker, Baghin Angelov, head of China Cross-Border M&A and Executive Director of China International Capital Corporation. He's going to talk about why he thinks that the access to foreign players will not automatically mean that they will swoop in to take over the market. I hereby give you the floor.
Yeah, I think can you hear me well? Just checking on the sound.
Yes.
Robert? Yeah, I think the video, I think apologies. I think maybe you can't see me on somehow, but yeah, thanks again. And let me pick up, I think, on your intro. So effectively, I think what we are seeing in China, it's I mean, a resurgence, I would say, of investments into China by foreign companies, in fact. And so if you look at into dynamics and into M&A dynamics, or outbound investments by Chinese corporates, relatively speaking, had been very strong historically. But really, I think what has happened was that because of obviously regulatory difficulties overseas, those have been coming down. Interestingly, the more important element is that investments into China have actually grown this year and have actually overtaken outbound investments. And there are a few reasons for that. I mean, one of the reasons is something where Mark already discussed. You have obviously many possibilities now in China for foreign companies to monetize, realize value by not only selling, but effectively being able to list in China on various listing venues. That's point number one. Point number two is that obviously there has been also opening up in terms of sectors of a negative list, which Mark already touched upon. So historically, where foreigners couldn't get control, they effectively now able to do so. So incentivizing really foreign corporates to come into China. And thirdly, also on the regulatory side, in particular, where it relates to public market M&A, you had in particular from this year on a lot of relaxations of effectively being able for foreign company much simpler to make acquisitions in China, be it acquiring a stake in a listed company, and without having to be locked up for 3 years, or without having to buy at least 10%. Actually, now you also can do share swaps, and so foreign companies can actually pay in kind rather than having to pay in cash. So it's significant simplification, I would say. So all in all, that really has been incentivizing foreign investments. But Robert, to your point, again, I think foreign investments into China are really also driven, obviously, on the back of a big market. But the important thing is, in all the situations, I mean, I'm observing the importance of localization, so being able to understand what consumers want in China, how supply chains work in China. Ultimately, really means that even though there's relaxation, and effectively even this year, with the foreign investment law effectively really harmonizing a lot of joint ventures and wholly owned enterprises, and also to the initial point that governance actually is now really being further strengthened, in particular from foreign perspective. So even with all those improvements, foreign companies still really prefer, at least what we've seen, to enter into some sort of cooperations. So we actually seen an uptake in interest for Sino-foreign joint ventures, and the reason is really because of the lack of understanding how China actually works, operates in certain sectors, but really also because the dynamics are changing so fast. And even though foreign companies, they could still, go public, let's say on the Shanghai Star Boards, effectively, alone and having a big presence in China, but still being able to really position the companies in terms of equity story, the business, and the outlook, still really requires a local partner shareholder. So in net, I would say really, I think what has been happening recently is a lot of positive developments on corporate governance, flexibility, how you can structure a deal for foreign companies, but at the same time hasn't really diminished the interest, and actually, I wouldn't say the need is the wrong word, but really the interest and the benefits which domestic shareholders can bring to a foreign investor. So for us, the outlook is very positive when it comes to foreign companies' activities in China. So we think that actually it's here to stay. But actually, that will drive a lot of the joint activities with local corporates in China. So we remain quite bullish.
But what I find interesting is what also Mark mentioned, and you mentioned the same thing, is the need or the wish for joint ventures when entering the market. Like I remember years ago when joint ventures were the only possibility to enter, and then many times, or there was a lot of resistance against joint ventures because of they were not very successful, and then the idea was that if you come to China, you should own everything, because then you can control it, and then you can do what you think is best. But now I have the feeling that we are moving away again, and then moving maybe back to the joint venture idea. And why do you think, are there other reasons next to market understanding? Why is that?
Yeah, firstly, I would say the corporate governance. So in particular, foreign investment law in China this year, I think, has really effectively, even the current joint ventures, basically have been given 5 years to adopt to the new, investment law, effectively introducing a board of shareholders, board of directors, and management. So really, I would say from a corporate governance perspective, I think the disadvantages of joint ventures effectively have been taken away. And even any new joint ventures really keep that in mind. That's, I think, point number one. Point number two, many of the joint ventures historically, again, where they were in the traditional economy, right? So they're manufacturing heavy. A lot of the new joint ventures are really in the new economy, right? So if you look at how many joint ventures DD, for example, is set up, they've done a joint venture with Volkswagen, they've done one with BP and on the charging station. So a lot of the new economy joint ventures, the new economy joint ventures are quite different because those typically, I mean, all of them, if not most of them, have really the objective to realize value not only by operating, but also by being able to effectively go public, at some point. So if you start from that perspective and objective, effectively, even leaving aside what you can do under legal regulation or regulatory framework, you would still, develop the corporate governance in a way that this company is effectively standalone, right? So
the new foreign investment law that has introduced those new governing rules has given a lot of the investors more confident in the ability to set up joint ventures due to the improved
as well
system.
I mean, I think that's helping, but I think the probably even more important has been the evolution of the Chinese economy, of like really going to the new economy, right, from traditional sectors into like internet business and mobility, etc. All these new joint ventures are much more, I would say, much more commercial. So they really are set up to effectively be standalone with professional management. So any joint venture these days I see typically addresses professional management from day one. Historically, really, maybe not really the case, right? You had some shareholders who second people to the joint venture, as you had the multiple roles have been covered twice. I mean, double appointed, right? You have a Chinese manager, general manager, you have a deputy manager appointed by a foreign company, a very difficult, management structures. I think that all is being addressed, even though regulation is, I think, allows that, but I think it has been even addressed prior to that. So even if you go back into the joint ventures last year, many of them are being just set up much more commercially. So I think the regulatory environment helped, but I think even more important, I think the evolution of a Chinese economy to new sectors, I think, has actually facilitated that as well.
Yeah, and but then I want to come back to the statement or the idea of your point, like that foreign companies can come into the market, but won't swoop in and take the whole market. I think specifically if you talk to, for example, custodian or finance companies, yes, they are able to enter, and maybe through a joint venture they have access, but they will not automatically take the most or the biggest part of the market. Why do you think that are foreign companies still in a disadvantage then?
I mean, I wouldn't say so, but I think unless you really localize in China. Actually, in fact, we have currently some interesting cases where, some American client effectively is redomiciling from the US to China and moving its management. I mean, unless you can really redomicile yourself, be exclusively in China, right? I mean, then maybe you can do so, but I think even if you look at wholly owned enterprises, that typically, let's say a BMW, right? They would have a company in Germany, or via let's say Holland, which effectively owns the entity in China. I mean, the management here, it's fine. They have the management, but the decisions, effectively core decisions, would still be done outside of China. I mean, if you really move entire decision making into China, I think you can probably, have a much bigger, bigger emphasis on the China market. I think be much more aggressive. But because that's probably not really happening, so then you still end up, with having, being together with a Chinese partner effectively. So, so that's one aspect. The second aspect is that, obviously it's not only for China, but if you look at the Asian countries, Japan and Korea, it's like still localization is a very important element, right? So I think for foreign company to really do it exceptionally well, anticipate all trends, alone, it's still a challenge. So typically they still do that, with working together with somebody on the ground. So So, I mean, again, I mean, to your question, I mean, would the foreigner be able to take up, let's say, a certain segment, sub-segment? I mean, I think it's not impossible. I mean, obviously, if it's allowed by regulation, I mean, they could do that theoretically, but practically speaking, to be able to do that, they would really have to, you know, effectively re-domicile to China to be able to really compete with other players in the market. But that will be probably, I mean, a challenge, at least, you know, at least for foreseeable future.
When you in the things you've mentioned, and I think that's interesting to also what Mark mentioned, many of the challenges you speak of are still very basic challenges that other industries have had in the past. Not understanding China, or there's a cultural difference, or there is China moves fast. Do you think there's a specific area for finance that is specific for finance that will be more difficult or different, or is it just another sector opening up?
Yeah, I mean, for finance, and obviously, I mean, this is where I work, right? So I think the difficulty is, you know, I mean, obviously talent, right? I think in China, I think it's even more so than other sectors. It's a very new industry, right? I mean, finance in China, very, very new. So, I mean, you will not find somebody who is in his 60s and now has like 40 years of experience in the industry. It just doesn't exist because it's a new economy, right? So a new industry, China. So, so experience is it's a resource which is not indefinite, so it's very limited. So to be able to really capture such resource, I mean, the, let's say, experienced bankers, etc. I mean, that will be one difficulty, I think, which many of the players in this sector will have. I mean, that's point number one. Point number two, obviously, like in any other country, it's a highly regulated sector, which means you need to really work with the regulators. So to be able to do that, again, you still need to establish that relationship, or you in-house that relationship by right appointments. So again, that's a difficult. It's not like, you know, you start producing maybe like certain pens, you know, like you start with bottles, and I mean, it's probably not as regulated, but in this case, to be able to go talk to CSRC, I mean, it will be a bit more challenging, you know, for a company which just sets up in China.
And do you think that the talent gap would it be? Do you see that as a risk for if we're talking about financial sector risk management and complex situation, then you need to have the right amount of the right caliber of people to manage that correctly. Do you see that as a risk, or do you say like, okay, China will be able to manage that quickly, or they will bring people from abroad, or?
No, but I think that exists in China, because maybe, I mean, in China, obviously, I mean, it has its own regulation and laws, and the framework is different. But I think that's more of a challenge for foreign companies, let's say in the financial services sector, right? Like if they really come to China, I mean, so you need to. There are many players, right? I mean, it's like all the state-owned regulatory bodies. So you really need to be able to have a very good dialogue with them. You need to anticipate changes in regulation before they come out, and how to interpret them. I think that will be an important element, again, because it's regulated.
Sorry to interrupt on that, to like interpret the regulations. Like I always when there are new regulation, when something opening up, and normally one of the best sentences in China I always think is like the Chinese characteristics.
Yes.
And I was wondering, where do you see the Chinese characteristics in this opening up of the financial market, or do you see any specific Chinese characteristics in this?
I mean, not really. I think it's. I mean, I haven't seen anything which is maybe, because it's still early days, right? I think in terms of, I mean, how it's evolving. I think that it's again, it's not happening overnight. I think it was communicated long ago, and at least I see on the ground a lot is happening also by foreign players. So don't see anything which I would say, look, I mean, it's maybe it's out of the norm. I think there's some challenges, but at the same time, again, many foreign players really have to understand the framework, how it operates. I think that will be maybe the bigger challenge, you know. So.
All right.
But the good thing,
thank you very much.
Just to conclude, I mean, the environment is very positive. I think it's in particular on the regulatory front, you know. So I think that is maybe which should give every foreign player, I think, a lot of positive, you know, momentum. I think to feel comfortable, you know, that actually they can take the steps now. Yeah.
All right. Thank you. It's good to hear that that you're bullish and positive about the future. That I think we need it a little bit in for inbound in China. So thank you.
Thank you.
Then I would like to go to Michael and sharing his day-to-day experience of operating in China. Michael has been in China over 12 years in different roles, and also in the last 2 roles as asset manager for specific projects. So a lot of hands-on, I think, knowledge also on deal flow and that kind of experience. So Michael, please share your views with us.
Yes, thank you, Robert. So yeah, indeed, I have been in China for quite some time, always helping Western companies do business with Chinese companies. With Rochefort & Associés, we are an investment bank working mostly on cross-border deals. So my objective today is to share really pragmatic business cases on what really cross-border finance is from our perspective, which is a private equity perspective. Basically, if we really look at the different types of business cases that we encounter in these kind of cross-border deals, in the past, what you really had was a lot of Chinese companies, Chinese corporates going out, making full buyouts of foreign companies. And now the nature of these operations has really shifted because obviously, as you know, the Chinese government has really tried to limit the outflow of capital to buy any kind of thing from, you know, brands to football clubs. So now it's much more limited. The government is really looking at these operations. So Chinese companies have to buy things that really make sense for them strategically. And it's mostly technology and things related to the core business. So you don't see as many of these operations as you used to. And now when it concerns technology, as you know, because of the situation with the Americans, but also in Europe, sometimes the countries are trying to limit these kinds of operation, or sometimes not blocking, but really looking very closely at deals of Chinese companies buying Western tech companies. The other type of operations that we see quite often and more often is Chinese investment funds participating in fundraising rounds of Western companies. So a lot of Western companies are opening their fundraising rounds internationally, and many Chinese investment funds are taking part. But they will be taking part mostly if it's related to technology, if they see a strong potential for China or for Asia, and if the round is significant enough. So now we talk to a lot of Western companies who are looking to raise money internationally abroad from Western investors, from Chinese investors, but they don't have a very good view of what a Chinese investor is looking for. And this is really important because this is the core of our business. Western companies looking to raise money, sometimes in China. Chinese investment funds will only look at targets if they are large enough. And a lot of Western tech companies are starting with really small rounds from just a few millions. At this stage, Chinese investment funds are not calibrated to make small investments abroad. They will not look at a round, you know, unless it's above 10 million for their investment, and even usually unless it's above 50 million. So, you know, if you're a tech startup based in Europe, having a Chinese investor in your first rounds is not necessarily a good idea. It's also not necessarily a good idea because the early rounds of fundraising are usually the people that you're going to partner with very long term and that are going to be very involved in your business. And going so far from your home base to get an investor is usually quite risky from a cultural perspective. So that's I would say that's another situation. Of course, you have another type of, I would say, cross-border acquisition, which are not really cross-border, but are large companies, large Western corporates based in China who are growing their China business through acquisitions. It has occurred a lot in the past, mostly industrial company buying plants and things like that. We think there's going to be a new opportunity for Western companies to grow in China this way again. First of all, because there's less restrictions in certain number of sectors, let's say automotive or others, and also because of the recent crisis, but even before the COVID crisis, access to funds for a lot of SMEs has been much more constrained in China. A lot of Chinese SMEs have had a lot of difficulty raising funds. So we think and we see that many of these companies can find themselves in difficulty finding money to grow, or even in difficulty, trying to survive. So there's going to be a lot of opportunities for Western companies to acquire some of these Chinese companies with valuations and multiples that are going to be much more reasonable than in the past.
Okay. All right. And yeah.
Yes.
Go on.
Yes. Another typical business case that we see are for Western investment funds investing in China. It's still a very exceptional case. Very few Western investment funds have teams in China. If they don't have a dedicated team in China, they will very rarely have, investments in China, because to really invest in China, you really have to understand and apprehend the Chinese market. And Western investment funds usually don't have the reach or the understanding of the Chinese market it takes to invest in China. I know, of course, of some Western investment funds who have built teams in China to have funds dedicated solely to the Chinese market. But in general, it's really difficult market to enter from this perspective.
And do you see any if you go to if you look at specific sectors, what has the highest potential in China? For example, for foreign companies or for PE to bring these companies to China, is that any specific area you think there's the highest potential?
If we're talking about companies who are not yet in China, the questions you have to ask yourself is usually really simple. Is look at sectors where companies where your company, usually companies from your country, have a very strong differentiation and cannot be easily reproduced or copied in China. So at this stage, in the previous years, the sectors where we see a lot of growth is essentially anything related to health and well-being, because as you know, the health market in China is developing and transforming very fast. So we see a lot of cross-border transactions of either Western companies looking for funding with Chinese funds, Western companies developing into China thanks to Chinese funds or thanks to international funds. So clearly health is one of the key sectors. We've seen a lot of education-related tech. Well, it's been back and forth, because there has been a first wave of growth in education-related tech, but then a lot of these tech companies in education have had a hard time finding profitable business models in China, and it's coming back, with the COVID crisis and development of distant learning. So this is also a sector to be looking at. Green tech is a very interesting sector, but it's also a complex sector because it's very related to real estate, and as many of people know, real estate in China is a very complex sector to penetrate. So I think green tech is a very solid sector to invest in or develop in China if you have a solid technology. But if your tech is more B2B reliant on industrial clients, so you can start building your base through Western clients in China. These are examples of sectors where we really see high potential.
Right. I have when I hear you talk, and I hear Mark and Brachin talk, is they are very positive. When I hear you talk, okay, yes, there's opportunities, but there are also concerns about entering the Chinese market. Are you less bullish on entering China than the other speakers, or?
I mean, I think there's two aspects to it. The Chinese market potential has always been huge, will remain huge for a long time. The shift and the difficulties may change in terms of execution. I think the complexities of the market are shifting. Some things in the past, some difficulties that were related to market maturity, lack of trained personnel, etc., are very different now. You have a lot of highly trained personnel. The infrastructures are much better. The partners that you have locally are much better. But at the same time, the competition is much tougher from local players. So I would say the difficulty is the same as it was in the past, in the sense that the market potential is always here. Difficulty really lies in execution. But why is it difficult to execute in China now is different from what it was in the past. Now it's really difficult to execute because you have a lot of very solid Chinese players who sometimes are doing the job better than you are because it's better adapted to their market, and their technology is just quite as good. So I would say that you can still be very bullish on the market, but you really need super solid partners or people to enter the market.
So again, I think when you say partners, again, what I hear is joint ventures, having strong partners, and not going in alone. Is that something that you agree?
It really depends. You can invest alone. You can do it fully organically, but then you have to be there for the long run. You're not going to make money right away. You need to have solid companies helping you, such as Sovereign, to really implement your business locally, hire strong teams, and the top management of your company has to be super involved in the China business. You have to accept that the top management is going to spend 30 to 50% of their time looking very closely at the China business, traveling to China. So you can do it without a partner, without a JV partner, but then you have to be super hands-on and super involved. Now,
all right.
Thank you. I mean, that I haven't made, and just to finish on that, is a case that we increasingly see is that Western companies who want to invest into Chinese tech don't really know how to go about it. So an increasing way that we see is that Western companies and investors are increasingly looking at Chinese funds, very specialized and vertical Chinese tech funds, and putting tickets into these funds to tap into the China tech market because they know they will not be able to do it alone. So that's another opportunity and thing that we keep growing.
So companies not investing themselves, but putting funds into Chinese funds that are closer to the market, and thereby not having the hassle, but having access to the profit. That's the idea.
Yeah, and also they don't do it solely for return. Obviously, a lot of these companies are doing it because they really want to get an understanding of the emerging Chinese tech. So in general, the situation is that we ask these funds to be able to co-invest in the rounds when they're really interested in whether of their targets. So it's really complex deals that you have to make with these Chinese funds, and you have to give them a sufficiently high ticket that they're interested in doing these kind of deals with you to have access to their companies.
All right. Thank you very much for those insights, Michael. We have one question, and I want to not the specific question. I will promise that I will answer the specific questions after the webinar. But it's a question also regarding COVID. Has COVID changed anything? And a very quick remark on that, where you see COVID changing. I would like to start with Mark. Where have you, what has COVID changed for finance?
Well, I think COVID has changed my movements around, but I think it was early on. We were relatively busy. People were restructuring or dealing with problems. I'd say September, October was very quiet because people were in a kind of paralysis. And now I think companies are looking and they see the light of the tunnel. So I think if we're talking about deal flow, COVID has had a big effect, but I think we're coming out of it. And I think it also has affected the sectors. because I think most of the kind of queries we get now are digital-based companies or service-based companies. We don't really see many people doing manufacturing or things like that.
Okay. Okay. Brachun, any thoughts on how COVID has changed the finance market?
Yeah, I mean, for us, I mean, maybe two ways it has changed. I mean, obviously, deal activity is different, right? So, I mean, outbound, as I mentioned, it's I mean, we can't travel, right? I mean, I think it's basically forced us to do a lot of the due diligence, etc., online. That's point number one. Point number two, it actually did have implications also in deals. So we actually see, as I mentioned, more inbound deals into China. I mean, it's become a very important market for many MNCs who already had a good presence here. Right? So re-emphasizes the importance of that market for, I mean, domestic and in particular foreign companies. So I mean, there are positive and negative, obviously, implications.
All right. And Michael, any?
Yeah,
where do you see?
I think what is important to pay attention to is that COVID has accelerated some existing long-term trends. You know, the healthcare sector, some other things like that. But I would really pay attention to not get into the short-term and fast trends. We've seen some things. Investors rushed through certain sectors, like, once again, distant education, like remote education, things like that. Post-COVID, we're going to get back to some realities. And I think some of these sectors are going to get back to the realities they had pre-COVID. So I would just be careful on, assessing if the opportunities in some sectors are not overly dependent on COVID. We've seen many people, who've invested like millions in masks, or in cotton to make masks, and now their machines are not worth anything because there's oversupply. So the key, I think, the nature of the opportunities in the market have not fundamentally shifted with COVID, and we have to pay attention to.
Okay. All right. I've promised the attendees to keep it around 50 minutes, and time does fly with 3 interesting speakers. So I want to thank you for your contribution. Points I took away from each of the speakers. From Mark, I think it was his idea that, if hypothetically Biden would become president, he doesn't see a lot of changes to the relationship, or immediate change to the relationship. He does see that non-performing loans is a hot market because they go where the money is. Brachun said, joint ventures are, I think, a new way, or getting popular again into this market. And it's mainly also because of the new economy, or how China is developing into the new economy. A challenge will be talent, but I think talent has been an issue throughout many industries in China. And where Michael sees a lot of opportunities also for not the startup, but for scale-ups, for bigger companies. For startups, maybe not, because Chinese investors are looking for bigger tickets, maybe starting at 10 million. And the execution is something that is very difficult due to maybe the misunderstanding or the cultural differences. I think there's one question. All right, I think, maybe this we have time for one question. There's a question regarding the IPO of Ant Finance. Does anybody want to say something about the suspension of the IPO of Ant Finance, and what this will affect for maybe the finance industry? Who wants to try? Otherwise, I'm going to choose a volunteer. Right, Mark, you move the first. Mark, it's going to be you.
I don't think. Well, look, I think the thing is, it does underscore to a degree what I said about Western governments can't control their companies as well. So I think the Ant Financial thing did show that in China, the government has a high level of control over things. I don't think it is something which will have any negative impact on the China financial markets. One of our clients actually is an investor in Ant Financial, so he was a bit sad that this didn't go ahead, but I think it will go ahead. It's just going to be a question of timing. So I don't see any long-term fallout or anything like that.
All right. With that, I want to thank all our speakers for contributing today. Also want to thank our attendees to joining and listening. After the webinar will finish, we will send you the recording if you want to read, and we also will send you the contacts of the speakers if you want to contact them any further. You also get our free copy of your Doing Business in China book. So if you are interested in moving into China, there are some handy tips about that. So with that, I want to thank everybody for joining and hopefully see you at one of our next webinars. Thank you very much.
Thanks, Robert.
Thank you.
Thank you,
Thank you, Robert. Thank you.